Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 139, we're going to continue our series on estate planning calculations. For this part 5, we're going to get into the calculation of a single life unitrust. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, this is a presentation for those gluttons for punishment who want to check the work of the calculators out there that do this stuff for you. So, the whole series on estate planning calculations has been all about how can you be less reliant on software and more reliant on your own knowledge and intuition when it comes to these types of things, especially when it comes to understanding how different factors and rates interrelate with each other and how changes in those rates affect the calculation of different types of split interests when you have maybe a income or remainder interest that you're dividing up and valuating for gift purposes and gift tax purposes. So we've gone through a number of issues with annuities and income interests for a single life and a term. We're now going to look at a single life unitrust. We'll look at a term next time, and then we'll get into where things get very difficult, and that's dealing with second to die types of situations with annuities and unitrust. But for the time being, we're going to bite off more than we can chew to begin with a single life unitrust, so we're going to try to not make you drink from the fire hose. But we're going to start off with an example where we have a client, Grant, who puts $1 million into a charitable remainder unitrust in February of 2021. So, what this trust provides for are distributions of the lesser of 5% of the value of the CRUT at the close of the preceding tax year, or, if less, the net income of the CRUT. That's distributed to Grant for his lifetime, and then at Grant's death, the remainder goes to one or more charitable organizations of Grant's choosing during his life, or of the trustee's choosing if Grant never gets around to doing so. So how much is the gift to charity here? Because ultimately, what Grant's doing this for is for purposes of an income tax charitable deduction, and he's also going to get a gift tax charitable deduction as well. So we're going to assume some facts that we need to know. One is that Grant is going to be 56 years old and is near his birthday. And the 75/20 rate for the month of transfer, February 2021, is 0.6%. Now, it was also in the previous 2 months 0.6% as well, in December and January. And that's important because when we're looking at the info we need, we get to pick and choose our 75/20 rate that we use. We can go backwards and use a 75/20 rate from any of the preceding 2 months prior to the funding of the CRUT. Now, it really makes no difference here, but there's a reason why you might want to do so in a falling rate environment, because the higher the 75/20 rate, the lower the adjusted payout rate, and this results in a higher remainder interest value. So if you can pick and choose, you're going to want to choose the 75/20 rate that gives you the best outcome. Now, beyond that, you need the age of the grantor at the grantor's nearest birthday. You need the payout rate that's stated in the CRUT. And then finally, you have to determine the frequency of payments. We're going to start off assuming annual payments, but that's rarely the case. If you have a more frequent payment, as we talked about in episode 127, there's adjustment factors that come into play. So speaking of, there's factors we're going to get from 2 specific IRS tables here. One is table U1, which is single life unitrust factors determined based on age and payout rate. So that's an important distinction. We don't care about the 75/20 rate when we look at table U1. We only care about the payout rate for the CRUT. And then on table F, this is the table you use if you have a payment more frequently than annually. And your 75/20 rate relates to that table in determining which adjustment factors you choose to adjust that payout rate, as we talked about in episode 127. So where this gets hard is in a situation where you have unitrust distributions are occurring more frequently than annually, because that adds several layers to the calculation and adds in a little bit of algebra, which you thought maybe you'd gotten rid of, but you have to now apply in real life, contrary to what you believed when your teachers said you're going to need this stuff when you enter the working world. Now, We're going to start off easy. We're going to look at an annual Unitrust payment. So step one, all we have to do is go to table U1 and we have to find the appropriate remainder factor based on the payout rate, which should be 5% here, not 0.6%, so that's a typo, and the age of 56. So I've highlighted that here correctly in the picture and not correctly in the slide description, but that'll be 0.32642 based on Grant's age of 56 and the adjusted payout rate of 5%, which isn't actually adjusted. We only have an adjusted rate if we have a more frequent distribution than annually. So our result here, we have the remainder factor of 0.32642, and we just simply multiply that by the gift amount, in this case $1 million, to determine the present value of the charitable remainder. So what that results in is 1 million times that factor 0.32642, and that's going to give us a gift of a remainder interest in the amount of $326,420. So Grant will get an income tax deduction in that amount and a gift tax deduction. Now we're not going to dive into the income tax specifics of how much you can deduct in a given year based on AGI and what the percent limitation is for CRUTs and things like that. That's a subject for another time, but what we are going to do is say that was simple, and we're now going to check our work. And lo and behold, using estate planning tools from Brent, Mark, and Limeberg, we get our exact example here. This is what we wanted to come up with, $326,420. So now that we looked at the easy one, we're now going to get into a quarterly Unitrust payment, and this will be the steps that we can use for anything that has a frequency more than annually for the payment of the Unitrust amount. So let's assume we have a quarterly payment, which adds many steps here. The first of which is now determining the adjusted payout rate. So before we even look to table U to find the remainder interest factor, we have several pieces that come into play. One, we have to find the adjustment factor for the quarterly payment that is based on the 75/20 rate of 0.6. This adjustment factor is found in table F. So as we can see with quarterly, what that means is that at least 3 months are going to elapse from the annual valuation to the first payout. Assuming you have a December 31 valuation, you're going to be looking out to at least March 31 to determine the close of the quarter, and you're probably going to have a distribution on April 1 or thereabouts. So less than 3 or less than 4, but at least 3 months gives us an adjustment factor of 0.996270. So what do we do with that? We take that factor and we multiply it times our payout rate to determine the adjusted payout rate. That's the caption we saw in table U, adjusted payout rate. So when we multiply 5% times that factor, that gives us 4.98135%. Now, given this, it's a little confusing, when you look at IRS Publication 1458, typically they take things out to 5 decimal points. We're going to check our work in a bit using the Brentmark software again, and we're going to see they only carry it out to 3 decimal points, which results in a small difference, but probably not a significant difference. But having said that, we put that adjusted payout rate to the side for now. So what we have to do is find the remainder interest factors under table U1 for the 2 payout rates in fractions of 0.2% that straddle that adjusted payout rate. So 4.98% falls between 4.8 and 5.0. So we're going to take our remainder factor at age 56 and 4.8, that's 0.33971, and we're going to find the other one, which we've already found in a previous step. That's the remainder factor at age 56 and a 5.0% payout rate, which was, as we recall, 0.32642. Both of those are from table U1. But next, now that we have those, we have to calculate the difference between the two. You subtract the lesser, which is usually the factor at the higher rate, from the factor at the lower rate. In this case, we're subtracting the 5.0% payout rate factor from the 4.8% payout rate factor, and we're getting a difference of 0.01329. Now we're going to find the weighted average. This is where the algebra comes in, because what we have to do is we have to take those 2 remainder factors and come up with our own remainder factor that's based on this adjusted payout rate of 4.98135%, just because table U goes by increments of 0.2%. So to get there, what we're going to end up doing is solving for x using the proportion formula, from algebra, where we assume that I couldn't really illustrate a good fraction here, but this is shown in IRS Publication 1458 if you want it. So you take a fraction, the numerator of which is the difference between the adjusted payout rate and the next lowest rate, and the denominator of which is the difference between the two payout rates for which we had factors we could use here, the straddle rates. And that's going to equal x, the factor we're solving for, over the difference in the two remainder factors, which is 0.01329. So calculating that out, we're going to end up with, I took it all the way out to the decimal points that my calculator gave me, but usually, at least based on IRS standards, you could take this out just probably 5 decimal points. So if we did that with just 5 decimal points, we'd have 0.01205. I just wanted to make sure there's no confusion in the math. And then we subtract that from our remainder interest factor at 4.8. And that gives us finally an adjusted remainder factor of 0.32766. Now, we have that. That's what we would have usually gleaned from table U, but since we had to figure out an adjustment factor in the middle of our two straddle rates based on the adjusted payout, we now multiply that adjusted factor that we put a lot of work into calculating times our gift amount of $1 million, and that comes up with a $327,660 gift of a remainder interest to charity from Grant when he funds this CRUT. As always, this will be a gift tax deduction and an income tax deduction potentially. So lots of steps go into that, and it takes a little practice to get there, but just remember, all you're doing is invoking basic algebra using proportion rules. You just have to know how you get the numbers that go into that before you solve for x. So let's check our work. Keep in mind I mentioned the difference in what decimal point we're taking this out to, and as we see in the Brentmark software here, they're only really taking this out to 3 or 4 decimal points when we look at, for example, the adjusted payout rate, which they've stated as 4.981, as opposed to over here we had 4.98135. So they've rounded down, and then we came up with an adjusted factor that we plugged in of 0.01203 as opposed to 0.01205 in our calculation over here, the bigger number we determined from our algebraic proportion. But long story short, we came close. We calculated $327,660, and due to rounding, Brentmark kicks out $327,680. Now I'm using Brentmark just because that's what I have access to. I'm not here to advocate for any particular software system, but there's a number of platforms out there that'll do this type of calculation, and I'd encourage you to take advantage if you want to do this and save time, and you're not a math nerd who loves diving into these numbers. But if you are, you now know the manual way to calculate the value of a single life Unitrust. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.